My head remains with my core framework, which has been we are still in a disinflationary world, and that interest rate rises are self-limiting because everybody's too indebted and the aging population, and that trend in bond yields I call the chart of truth, where bond yields go down over time, holds. That is currently the least popular view from most people. Everybody, and I've interviewed everybody that I know and really respect. Just did an interview with James Aitken, Gerard Minack, Kirill Sokolov. They've all changed their macro view. They're like, structurally, we think there's long-term inflation. And their view is, we think there's long-term inflation because of the amount of spending that will happen to transition to ESG, and there's not enough commodities to deal with that. Absolutely true. That supply chains are coming back to regionalized, so people need to build new factories. And I think that's true too. I still think that the demographic story is larger and that demand for commodities is driven by the economy itself. And so I know it's fiscal stimulus, but at the margin, if households spend less, then the price of commodities comes lower. I think overall, I still think commodities come lower than here. The big question for me, I think we're headed towards recession. Now, again, as ever, everyone's saying, well, this time it's different. The forward part of the twos curve doesn't suggest interest rate cuts. The 3-month, 10-year is not inverted. There's always a but this time. I generally look at all the forward-looking indicators that I've been using for the last 20 years. Most of them are weakening, showing weakening growth. I don't have many things that give me a recession yet. So it kind of feels like 2006, where the yield curve remained inverted for a period of time before the actual bad news comes. No, it's happened because of commodity prices. What we've had is a massive tightening of monetary conditions because wages have gone up 5% and inflation's gone up 7.5%. So what you've done is destroyed demand by 2.5%. So that basically, if the trend rate of growth is 2.5%, you've just gone to zero. So I see that in inventories to new orders in ISM. That relationship suggests that the economy is headed to pretty close to recession. I look at shipping, freight, all of these indicators, the year-on-year rate of change, they've all gone to recessionary levels. So something's going on. Consumer sentiment, the University of Michigan's consumer sentiment indicator is recession levels. It's consistent with the yield curve. Small business optimism, falling, not yet at recession levels. ISM new orders, falling, not yet at recession levels. The ECRI year-on-year survey, the Economic Research Cycles Institute, that is, again, pretty low, near zero. So there's a lot of indicators that are like, listen, ISM is likely to get down to between 52 and 50 between June and July, something like that. Usually the Fed stops when that happens. Well, because we're living through a structural change of which none of us have gone through before. So we're grasping for past histories. Is this 1973-4, which was the Arab oil embargo, where the US had underinvested in the oil infrastructure. The Arab oil embargo came, oil price went up. What happened then actually was the economy collapsed. Inflation went up, and then inflation came straight back down, and the economy came back down. Now, that's kind of what I think is happening now. It also could be the 1940s and 50s all over again, where you had massive fiscal stimulus, inflation spiked after World War II because there wasn't enough supply, it settled down, and what you got was a period of extended growth. Inflation was okay, and bond yields remained low, and equity returns were really good. Most people are expecting something much more dramatic, which is that inflation stays much higher. I don't know what that means, whether they're talking about 3%, 4%, or, I would suggest that CPI stays between the 2 and 3% kind of, 1 and 3% area. So in that, maybe bond yields trade sideways, but I don't see them breaking out from 3%, which would be a new high cycle high that we've not seen before, because that's not happened in 35 years. So we'll wait and see. I mean, it's a big picture change. I mean, you know, the Russian situation is like the Arab oil embargo, so we've seen that before. But then this massive shift to ESG, which is a huge kind of global stimulus, where the ECB needs to retool the Europe needs to retool its entire economy. But we've also never had that with the largest amount of aging population of all recorded history and the largest debt load. So who the hell knows?